Happy holidays from the Keen Wealth Planning Team.
Happy holidays from the Marketing, Compliance, and IT team.
Happy holidays from the Keen Wealth Planning Team.
Happy holidays from the Client Services team.
Happy holidays from the executive team.
Happy holidays from the Keen Wealth Planning Team.
Happy holidays from the Keen family.
Hello everyone, Bill Keen here. As 2025 comes to a close, I want to take a moment to say thank you from me and our entire team at Keen Wealth Advisors. We are truly grateful for the trust you place in us to be a part of your financial lives and your family's stories. For some of you, we've now had the privilege of working with multiple generations of your families, and that is an honor we do not take lightly. Whether you've been with us for many years, just joined us recently, or tuned into one of our webinars or podcasts this year, we're so glad you're part of the Keen Wealth community. The best part about the work we're privileged to do at Keen is seeing you enjoy the things that matter most: family, travel, volunteering, and all the experiences that make life and ultimately retirement meaningful and on your terms. That's the heart of our work. Helping you create a plan and then seeing you bring it to life is truly the most rewarding part for our team. I also want to give a big thank you to our amazing team here at Keen Wealth. Their passion, professionalism, and care for our clients are unmatched. Every day they go above and beyond, and I couldn't be more proud of the culture we've built together. Now, many of you joined us at our holiday celebration at our headquarters here at Lighton Tower earlier this month. And what a great time that was again. We had Santa back, wonderful music from our live harpist, and our great and talented friend Anna Brabston. Excellent food prepared and served by the amazing Local Seasons Catering, and plenty of fun for the kids, from cookie decorating to crafts and reindeer games with our friends from the Farmer House. It's always one of my favorite events of the year because it brings together so many of our long-term friends and new ones too, and lots of family members, next generations, grandkids, and my own family, and all 4 of my grandkids were on site that day. In that same spirit, our team is already beginning to plan for our summer barbecue, which will be returning in May. We'll again have great food, family fun, and plenty of opportunities to connect outside the office. Keep an eye out for that date and plan to join us if you're able. This year was also impactful for our Keen Wealth Foundation, led by my wife, Carissa, and supported by the entire team at Keen. We were honored to partner with multiple wonderful local charities again this year, and our team volunteered hundreds of hours across organizations such as the Farmer's House, the Veterans Community Project, Angel Flight Central, and the Boys and Girls Clubs of Greater Kansas City, to name a few. In fact, the Farmer's House was our 2025 Community Impact Partner of the Year, and our team really enjoyed getting to know their amazing community. We were able to spend time volunteering with them multiple times, including hosting mock interviews here at Keen for the farmers, which was wonderful, and helping to host a fun dance for them earlier this year that was a great time for everyone involved as well. Giving back to the community is such an important part of who we are, and we look forward to finding even more ways to make an impact in the years ahead. Now I'm excited to turn things over to Matt Wilson, our President and Chief Investment Officer. Matt and I have been working together for almost 25 years now, and I can tell you there is nobody better at helping our clients make sense of the markets, stay focused on the issues that matter, and as important, tune out the things that don't. He's going to walk us through his 2026 market outlook, and I'm certain that you'll find it insightful. On behalf of myself, my wife Carissa, and our entire team at Keen Wealth Advisors, we wish you and your families a wonderful holiday season and a happy, healthy, and prosperous 2026. Matt, take it away.
Well, welcome everyone to today's webinar. As always, we've got a great one for you. This is our year-end recap and outlook for 2026, and it's been a great year in the markets for 2025. Looking forward to kind of going through what happened here and then what is in store for 2026. Yeah, there's been just a lot of interesting dynamics this year. Markets, as I talk about a lot in the webinars that that I host over the course of the year, they don't go just up in a straight line. They have trends from time to time where they're trending higher, trending sideways, maybe trending lower. But this year we definitely had some interesting dynamics and market volatility, both to the upside and to the downside. And here we are at the end of the year, and we've had a good year, and we've had a very good performance in the overall equity markets and really in the bond markets too for the last few years. Here I've got different asset classes, and they're all represented on this graph with different colors, but they all trend in the same direction. You can see some perform better than others. Top performing asset classes this year were both asset classes that were for companies that are headquartered overseas. So the number one performer, and this is as of a couple of days ago, was the international markets, and it was represented by developed countries. So these are countries that are similar to the U.S., more established. Next, we have emerging markets just right behind. So those performed very well and really weren't impacted nearly as much by the tariffs and whatnot. That was a big issue that popped up at the beginning of 2025. Next, we've got the NASDAQ, which represents a lot of technology stocks. Then the S&P 500 up 16% for the year, followed by small caps. Then we have the Dow Jones, which is 30 of large industrial companies, commodities, and then lastly real estate up 3% for the year. So still positive, even despite a lot of the negative narrative around real estate. But what you can see is, look, we had a decent start to the year, January, February, and then in March, when a lot of the tariff discussion became more serious, markets were reacting, and they started reacting very negatively all the way into April. Announcement came out that the tariffs were on pause, and then we saw a very quick and steady rebound, and that fairly, that pretty much trended through where we're at today. And that's what happens. Whatever the headlines are at the time, that's generally what happens. If you go back and you happen to look at some of the webinars that I've done this year and even in previous years, when we go through those scenarios, what we're talking about at the time is forward returns, because we have to look at, well, if we were to look at, okay, we are where we are today. It's not about how much markets are down from the peak. It's just we are where we are today. And is the outlook, has that changed significantly? Potentially. Is there economic data that has gotten much weaker that would maybe indicate that we, here in the US are headed into a recession, to where, okay, the ability for companies to earn money, to make earnings and be profitable, is that impaired, and will it get worse before it gets better? That's the decision and the analysis that we have to make. And that's what I like to do, is talk through those things, because if the analysis is that, well, the economic data hasn't gotten worse, so we have to say, okay, well, if we were to invest today, or if we were to hold the current positions, our forward returns, what are the alternatives? Because a lot of times in those moments, you want to sell everything, move it all to cash, or change it into something that's been performing slightly better, whatever that may be. Could be bonds, could be fixed income, go buy some CDs, whatever it is, because it feels like that's the right thing to do. Because if you're looking at headlines, you're looking at the media, they're just talking about what's currently happening and what's happened most recently, which is typically negative, but it's driven by performance too. If you look at the headlines all the time, I mean, generally they aren't that positive. It's because people don't pay attention when they're not positive, so they want to grab people's attention, and they want to start with something that's a little more shocking, I would say, to get people's attention. So we always have to make that analysis and look at, where are we and where do we go from here? That's what it's always about. Where do we go from here? And then for the clients that we work with, depending on where you're at, if you're retired or and pulling out money, or if you're still saving, I mean, that also frames how you feel about what's going on. But two, if you're retired, you're pulling out money, well, we structure portfolios in such a way to get through these things when we have this volatility, because we know it's going to happen. Yeah, I can't predict what the next headline's going to be, or what the next market movement event's going to be. We can talk about what risks there are, and we have some of that, where I'm going to go through what some of the risks are in 2026. But a lot of times those risks are known. It's the unexpected risks that the market reacts negatively to. The current known risks tend to be priced in fairly well. So anyway, interesting kind of to see how the market reacted this year. Here is a breakdown of all of the different sectors of the market. These are sectors within the S&P 500, which I talk about the S&P 500 a lot, because it's a broad benchmark, but it does represent more of just the large companies, and it's weighted towards large companies, skewed that way, and especially skewed towards tech stocks. And you can see, tech has performed well this year, followed next by communications stocks, which there's I would say some kind of tech related companies that fall into the communications sector. Then you have industrials, kind of not, all very close to that. And then the fourth best performer is utilities, which for some folks, they feel like, well, utilities aren't really that exciting. They're kind of controlled monopolies, but utilities have had a great year. Now let's talk through the fixed income market, or the bond market, as I call it from time to time. So here we've got different yields of government bonds. So these are, you loan your money to the government, they pay you a rate of interest, and you get your principal back when the bond matures. And the yield is what you earn when you buy or purchase the bond. In the top one here in the purple, we have the 10-year treasury. So you loan your money to the government for 10 years. This is what you earn. began the year close to 4.5%. Now we're sitting at 4.2 roughly, on this graph, slightly below that. Red line we have is the 5-year yield, and then we have the 2-year yield at the bottom. You can see all three of them. They all started the year higher. Yields are lower, and few reasons for that. One of them being that inflation was higher at the beginning of the year. The Federal Reserve had gone through a process of raising rates in 2022, and now they're in the process of lowering rates. They've been a little more aggressive here recently, in terms of lowering rates. Not necessarily making big rate adjustments, but more so at each meeting, continuing the process of lowering rates by a 0.25% or so. And they're indicating that inflation is slowing. They're not saying inflation is going away or going, prices are coming down. They're just saying the rate of price increases is slowing down. And that's normal. Typically you see prices slowly increase over time. And again, we had a period through COVID and kind of post-COVID where prices increased significantly. So that previous slide, that was the interest rate that you earned on loaning your money to the government. Now this is the performance of those bonds, because those bonds, they fluctuate in value. People that are maybe new to the bond market don't always realize that. If you're used to purchasing CDs, you don't see CDs fluctuate. You just see, okay, I put a deposit in. Depending on the length of the CD, you might get some interest throughout the year, or they might just pay it at the end of the term, depending, again, how long is the holding period for that CD. When you own bonds, there's a market for bonds, and you can sell your bond at any time. You don't have to hold it to maturity, and that's common. That's what happens a lot in the bond world, especially with bond funds and bond ETFs and different institutions. They have liquidity needs, and so they liquidate bonds from time to time. And so your bond price, or the value of the bond, is going to be impacted by what current interest rates are. So if you have a bond that has a high interest rate, you might have a gain when you sell that bond, and vice versa. If you have a bond with a low interest rate and interest rates are currently higher, you might have a loss if you wanted to sell it, because someone could go buy a new issue bond and get a higher rate of interest. So they have to account for that when they price bonds. Other factors that determine the value is, how long is the bond? Is it a 30-year bond, which is a very long time, or is it a 1-year bond or note? And then also, what's the credit quality? Now, these are all government treasuries, which are considered kind of risk-free from that standpoint. The U.S. government's never defaulted. They do issue credit rating agencies do give the U.S. government a credit rating, but they've never defaulted. Whereas corporations who also issue bonds, they can default. It doesn't happen very often, but that can happen. So there is a risk of default that gets priced into these as well. Well, if you look here, you can see, okay, well, these are all squiggly lines, and you can see some fluctuations here, but most of them had trended higher throughout the year, and that's because as interest rates come down, existing bond values go up as those interest rates come down. But you would think, okay, well, the longest term bond should have the best performance, considering, well, we started the year higher, now we're currently lower, but there's again volatility associated with that. And so TLT, which represents 20-year or longer U.S. Treasuries, actually is one of the worst performers this year, followed then with the 10 to 20-year range. Then you've got the 0 to 1. So that red line, I mean, it's not money market, but it's the the bonds or notes that mature in less than a year. So they're very short-term in nature. So they don't have a lot of interest rate sensitivity because they're constantly maturing and you're reinvesting at current rates. So those, those in the blue line too is just slightly longer in maturity, but the best performers for the year are in that 3 to 10 year range. Interesting that dynamic, because again, just not knowing anything about what happened throughout the year, you might think, well, why would the 20-year or longer actually be the worst performer? And it's some of that prices in what the outlook for future interest rate items are. So now let's go through the economic data. This is the data that I cover during all the webinars. So just give a quick overview of where we're at. We've got unemployment here, or excuse me, the employment payrolls in the U.S. 159.6 million workers here in the United States. That's up from our kind of COVID peak of 152.5 million. So still trending higher, still positive. The rate of increase has definitely slowed down, but it's still increasing. And again, I'm big on trends, not just one data point at a time. This is job openings too. Job openings has stabilized here throughout 2025. In that 7 to 8 million range, and kind of been that way for a while. Was much higher post-COVID. There was a lot of companies that were looking for employees, but still high, and still higher than the previous kind of COVID pre-COVID peak. So employees or employers are still looking for workers, which is an important component to the health of the economy. Now we've got unemployment claims, and this has been fairly steady throughout the year, kind of bouncing around in the 1.6 million to 1.8 million. But this is when people get laid off and they continue to file for unemployment. And I go back 10 years on this graph to show you, we had this huge spike during COVID in unemployment claims, but then it's trailed off and been fairly steady. Retail sales, this is when people purchase items. That's been still trending up into the up into the right, as they say. That's been positive. Now we've got building permits. This is for new housing, and that has been a weak point this year. You can see where we're at. It's definitely trended lower in the last few data points. Housing, with interest rates where they're at, and housing's expensive. It's just not as attractive as it was when interest rates are lower. But the price of new homes too is very high, and that makes it difficult. Now, housing is it is a unique thing here in the United States because there's not enough housing for essentially the demand. So even though we're having building permits kind of trend low, like significant housing collapse, in prices that we saw during 2006, 2007, prior to the great financial crisis that started in 2008 and really bottomed in 2009. That was an oversupply of housing. There was way more houses being built than were needed, and a lot of different loan types and housing, and that's definitely not the case today. Now it's more of an affordability issue. It's not crashing the prices. You're definitely seeing some weakness in the coasts in terms of house prices, but I also think people aren't feeling like they have to liquidate. That's the other issue, where in 06, 07, there was more of a need to liquidate because of the speculation that was happening and people just being over leveraged. And then they couple that with a weak economy, people started losing their jobs. They needed to kind of fire sell those homes or give them back to the bank in some cases. And that definitely had a significant impact on prices in the housing market. This is business spending. Business spending has still been trending in the right direction, was going sideways there for a few years, and then from kind of 2024, 2025, we're seeing that little uptrend there. So businesses are continuing to spend money too, which is another, good sign. And then this last graph here, I have the yield curve. This was, something that we do follow closely because it does help us get a sense of, how tight is the money supply? Is access to capital? Is it easy or is it difficult? And when you have an inverted yield curve, that's what all these red circles represent. This is going back into into the 80s here. You've got short-term rates higher than long-term rates. So you can go get a 3-month treasury. So, kind of think of it this way. Like you can go put your money in money market or you can go buy a 5-year CD. Well, in these red circles, the money market rate is higher than the 5-year CD. So that incents people not to put money in the 5-year CD. They just want to own the money market because the rate is higher and they have access to it. It's liquid. So that's called an inverted yield curve. It doesn't happen that often, but when it does, that is an indication that that money supply is tight, and that could be a sign of a recession on the horizon. Because all these graphs, these are Federal Reserve, and what they have on here, we have these gray bars. You've noticed that in some of the graphs that I've gone over, and those gray bars represent recessions. And you can see every time the yield curve has inverted, there's been a recession that followed the inversion. We haven't had one. We had an inversion here in 2023, 2024. It's uninverted here currently because short-term rates now are not higher than longer-term rates. There's not a huge delta or difference between short and long-term rates, but they're not inverted anymore. And that was when this inversion has happened over the last few years. There was a lot of discussion over a recession. And you might think, well, why does that indicate? It's like, well, typically what it means is that the Federal Reserve is so worried about inflation and the economy maybe getting over capacity or getting too hot, as they say, and it wants to cool things down. So it wants to slow the rate of growth down, slow the rate of inflation down. So they raise rates. And when they raise interest rates, that incents people to hold on to more cash, put it in CDs, put it in money market, incents businesses to take out less loans because the cost to get those loans is higher. And when money is kind of parked or not being lent out, well, then that can constrain or slow the rate of growth. And at a certain point, that starts to just be too restrictive, and that can lead to a recession. So that's the thought around the inverted yield curve and why that can lead to a recession. However, again, as I mentioned, we haven't had a recession, and I think part of the reason for that is because the Fed has been very active in the bond market, especially the U.S. Treasury market, since 08-09. They've been doing things like quantitative easing and quantitative tightening. So they've been out there basically making artificial supply and demand by buying or selling or not reinvesting their holdings when they mature. So that has impacted interest rates in a way that I would say hasn't been the case in the past. So it is truly, even though we don't like to say this time is different, I do believe it was different. There were different dynamics that were happening, and I think that's why we haven't seen a recession kind of post this inversion as we've seen in other other prior inversions. Well, this is The outlook for corporate earnings, and this is a very important slide. I think this is probably some of these couple of slides here, probably the ones that people like to focus on the most, because this is where I provide some ranges for forward returns. And the reason I talk about earnings is because the stock market, so S&P 500, all the stuff I showed at the beginning of the webinar, the value that is being represented. So when we talk about like Dow, this is something I had a lot of conversations here recently. We just had our annual holiday party at our office, and I have my hat, my giant hat that says Dow 100,000 on it. There, you can see it here. I won't put it on because it'll mess my hair up, but Dow 100,000. And it's so many people, even this just at our open house. They're just, well, I don't think we're going to see that in my lifetime. We're nearly at Dow 50,000 today. And I remind them, like, we were at Dow, the Dow was at 10,000 in the late 90s. So, okay, 25, 30 years later, it's up almost 5x during that time frame. So let's just go out. I mean, let's just another 25, 30 years, highly likelihood a lot of the people who are talking to could live that long. If you just say it goes up another 5x, well, we're going to be well past Dow 100,000. That's just a 2x from here. And it's just the number. Well, why is it 50,000? Why is it 10,000? Why is it 100,000? Well, because it's a reflection of earnings. Corporations they grow their earnings, and stock prices are a reflection of that. So it doesn't just go up just because it's investors look at, okay, how much are the components of the stock market or individual companies, how much are they making? Are they profitable? Are they growing their profits? As an individual, you might think about it. It's like, well, what's my net income? Especially while you're working. You can look at your Social Security history, and you can see, well, 30 years ago, I earned this, because that's what they tax Social Security on, and they just tell you exactly what you reported for your income. And if you're working again, you'll see, well, this is what I earned today. That's your earnings. Well, corporations have the same. They have corporate earnings, and corporations are in business to make money. And that's why all these different headlines that we have and all the different economic variables with interest rates and whatever, taxes, all that, I mean, those all have short-term impacts and issues related to earnings, but long-term, corporations figure it out. That's what history has proven. They have figured it out. And that's why we can't get too hung up on the day-to-day noise and just focus on the long-term trends. Well, here's the outlook for earnings for 2026. This is broken down by quarter. So you got Q3 2025, Q4 2025. The first two shaded, I guess, bars here, because the solid ones are those quarters are over, and those you would say are finalized earnings numbers. 2025, the estimate's looking to be right around $270 per share, and that's again of the S&P 500, and it's basically taking all the companies in the S&P 500 and breaking them up and weighting them based on on the size of the company within the S&P 500. And the estimate for 2026 is $309 a share as we go through 2026 at the end of the year. Well, let's kind of talk through the market multiple. So again, as those of you that have seen my previous webinars, this is the outlook based on estimated earnings, where they're at today, and then different multiples. So investors are people, which is like the market is just a conglomeration of all the people, and they assign a multiple to it. Now, whether you're really thinking that way or not, that's kind of functionally what's happening when prices are being they're being moved up or down. And you can say, well, people are willing to pay more for future earnings or pay less for future earnings based on what that multiple is. And that multiple is influenced by, again, the economic outlook, interest rates, alternatives to owning stocks. There's a lot of different variables. In any given day, those variables can be constantly in flux, but over time, really it's interest rates. That's a big one, especially depending on how high or low interest rates are and for how long, and long-term economic trends. Those are really the biggest factors, and of course the ability for companies to make money. So let's talk about our outlook for 2026 based on earnings estimates. So what I've done, I take the last quarter of the S&P 500, the estimated earnings of Q4 2026, which is almost $83 a share for the quarter. You multiply that by 4 or annualize it, so that's $330 a share. And then there you take that estimate and you just kind of run it through some different multiples. And no one knows what the exact future multiple is, but we have what current multiples are, where actually current multiple is closer to 25 if you just take the current S&P 500 as a 1215, which was just over 6,800, divided into the current earnings that we have for the S&P 500, and you get about a 25 times multiple. Well, if we look at, okay, let's just say what would cause multiples to go down? Well, some of the risks that I'm going to cover, in the next few slides, maybe those do become more significant. They are priced into an extent, but then something changes related to that risk, or it becomes much worse. There's probabilities that people probably assign to some of these risks. Like, one of the things that we talk about a lot, get a lot of questions on, is like the government debt here in the U.S. At some point it may matter, but the current risk is that it doesn't matter. So it's a very low probability that the U.S. government's going to default on that anytime soon. I say that like over the next 12 to 18 months, the very, very low probability. So even though it might be a concern, not a high probability risk. Is a risk of a recession higher or lower in the next 12 months? I mean, that does change kind of each month with jobs data as that comes out. But that's definitely something that will impact these multiples. Interest rates too will impact the multiples, where Fed is now in a lowering of rates mode versus a raising of rates mode. So we have 18x on the low end, and it could be lower than that again if things got significantly bad here in the U.S. economy, up to 24x on the high end. And again, it could be higher than that. I mean, there's no set range that the price of the S&P 500 has to stay within. It will fluctuate, but I think this is a very good range of outcomes, with the 22x and the 24x being a very high likelihood based on where we are in the economic environment. Within the data is still trending positively. Companies are still earning, still making good earnings, and outlook for earnings is good. We still are adding jobs here in the U.S. Employers are still looking to hire, not necessarily at the same rate that they were hiring over the last few years, but they're still looking to hire. Those are all positive trends. Well, if you take, okay, here's the range of possibilities, and you compare it to where the current value of the S&P 500 is, our range is anywhere from a return or a negative return of 12% up to a positive return of 16% over the next 12 months. So call it year end 2026. And I encourage everyone, go check out my webinar from 12 months ago. The high end of the range, which I said I think was highly likely to happen, was just over 6,800 on the S&P 500. Not to say that I had a crystal ball and knew exactly what would happen, but this is, again, how outlooks are valued and looked at. And again, it's all a function of earnings. Now, we'll adjust as earnings outlooks each quarter. Earnings outlook, changes, adjust based on what corporations happen. It's a constantly changing, but this is the current outlook for stocks over the next 12 months. And interest rates, the outlook too for interest rates is to be slightly lower. This is where investors they hedge future interest rates via the they call it the futures market, and this is data that's published by the custodian, that the exchange that houses all of these futures contracts, and they show where the probabilities are that investors believe interest rates will be at the end of 2026. So the current interest rate range 3.5 to 3.75, and the range 1 year from now 2.5 to 3.5. So the expectation is that interest rates will be lower at the end of next year. So that's it's a positive outlook for current bond prices. You'll see gains in bond prices. Yields will be slightly lower, but you'll see gains there on on the value of those bonds. Now let's talk about 2026 and what some of the risks could be. There's a lot of risks here that I have laid out. This is a survey that Deutsche Bank puts out, and this is actually the screenshot from a year ago. And they still have the same questions for 2026. They just haven't published the results yet. And but these are the probabilities, and I don't think they're going to be much different for 2026. I'll update that in our Q1 webinar when we go through our quarterly outlook in Q1. But here's where here's all these possibilities. And again, I think most of these are priced in. These aren't unknown. These are things that everyone has on their radar. It's the things that people aren't aware of that causes concern, or the ones that have a very low probability that all of a sudden become a very significant issue in a very short amount of time. But yes, some of the risks, is we've had what we call a soft landing, but the economic data, the trends are positive. Will that change? We haven't had a recession in 2025. Don't foresee any of the recession. The people who call recessions, and it's the different bureaus, economic kind of bureau of research and different things, and they they're the ones who kind of determine recessions, and they're not indicating that there was a recession in 2025. Now, again, is that risk going to increase in 2026 based on current data? I don't believe so. But that could change if corporations all of a sudden start laying off a bunch of people, the risk of a recession goes up much higher. Does the Federal Reserve stay on this trend of lowering rates, or do they abort that because inflation gets higher? Is the deficit going to be a concern? It truly hasn't been, but is it going to be a concern? And the market multiples. I said it's currently at 25 and showed a range of anywhere from 18 to 24 in the future. Is that going to be an issue? When you look at historical data, there's a lot of discussion that valuations, that these multiples are high relative to history. And you can look at historical price to earnings ratios, and you can see that they are higher relative to where they have been historically. But that doesn't mean they just have to come down. And there's different things that are happening today that weren't around 30 years ago, 40 years ago, 50 years ago. So it is hard to just say, well, they should be, because long-term average on valuations, let's just say it's 15 times. And we're at 25. People, well, that's a much higher. Well, there's things that are different today that didn't exist back then. I think one of the big things is that access to information is much more available to everyone than it ever has been. I mean, it's instantaneous, and investors, people, whoever, you can get information as much as you want, as quickly as you want. And you couldn't do that 50 years ago. You didn't know what was happening in the stock market unless you saw it on TV, or if you read the paper based and looked up the stock values from the previous day. You weren't getting updates on your phone second by second that the stock market is open. So, I mean, these are different dynamics, and that does impact stock prices, because people have information now, and they feel like they can make a decision much quicker, and so they're willing to pay more for future earnings because of that. As I mentioned, I think a lot of these risks, though, are priced in. And again, some more than others based on kind of how probabilities people are weighting those. But it's the thing that no one's paying attention to, or at least has the very lowest risk assigned to it, that is probably going to cause the most volatility. But volatility is normal. That's the issue. It's like, and we say volatility. It's like, well, you can have upside volatility, prices going up, but downside volatility is what I'm referring to when we talk about that, and it's when prices go down. I show this graph a lot because I really do believe this is a very good visual. So what this shows, this is the S&P 500. This is going back to 1980, and what it has is the bar, the gray bar at the top, is what happened at the end of the year in terms of performance for the S&P 500. How much it was either up or down. So if it was above that black line, it was positive. If it was below it, it was negative. And then the number is what the return was. The red dot, what that shows is the peak to trough decline throughout the year. So what you can see is that at basically every single year going back to 1980, markets went down from the peak. They don't just go higher every single day. And we all intuitively know that, but it's very helpful to see this, that some years more than others, but you can have a year where the market dropped at some point throughout the year. Doesn't mean the return went negative for the year. It just means it dropped from a peak to this, bottom point, and then resumed the uptrend again. The peak to trough decline. And some of them are significant. In some years, we had a bad year. You can see the big outlier here is 2008. Then you had what happened in the tech bubble, 2001-02. But most of the years it's higher. Those red dots represent volatility. And here's 2025. This date is as of December 12th, up 16% year to date, which is kind of what I showed in the beginning of the webinar. We had a drop of 19% when those tariffs and tariff tantrum and everything else was happening in March, April. And it's still up 19%. So at one point the market dropped 19%, but now we're up 16 for the year. And that's what I was talking about at the time when I was going through that slide. The future returns, like if in the bottom of April, if you add the minus 19 to the plus 16, where are you at there? 35%? That's the return from that point forward. It's forward returns, when we go through these periods of volatility. And so we have to look at that volatility as opportunities, because when you look at all these gray bars, it's like, well, it's always higher. Like, we haven't had a permanent decline ever. It's always been temporary declines. You could say the advance has been permanent because it advances way more than it goes down, because it never goes to zero, and especially a diversified portfolio doesn't go to zero. And so volatility, again, it's not a bug, it's a feature. It's part of investing. And this is the price to earn, the rate of return that markets provide that are over and above what you can get in cash, money market, whatever, the risk-free rate. So while, yeah, we don't know exactly what is going to happen in 2026, there's definitely some things that we're looking at, and we look at what's going on in the U.S. market and what's happening with AI. That's going to be a big driver of the narrative in 2026. Are companies going to continue to spend on that? And how's that going to look? Is the labor market going to continue to trend higher? It has been, and I think it will. Consumer spending's been strong. Consumers have not been impacted by the tariffs. Household balance sheets have still been very strong. Low debt service ratio. That's a big thing. You always hear aggregate numbers like, well, debt is the highest it's ever been. Well, it has to be relative to incomes and the ability to pay the debt, not just a number, because numbers get bigger. That was my point with like the Dow 10,000 or Dow. The number gets bigger. It's all relative to earnings. So, debt, the number itself doesn't matter. It's just, can we pay the debt? Can people pay their debt? Can they pay the interest on a mortgage? That's the debt service. Housing too. I think housing will pick back up because there is a lack of supply. That is an issue, and there is demand for it. Interest rates are coming down. I think that's going to help too with mortgages and provide some tailwinds in housing. And two, global growth too, I think will pick back up. With just continue acceleration here in the U.S., consumers they're actually in a good spot. They're continuing to spend money. The tariffs aren't an issue. We might get some more clarity on the tariffs, whether they maintain or not maintain, but it really isn't much of a headline as it was earlier this year. So just to reiterate where we're at with our outlook, we can see anywhere. I think this would be if economic data really starts to look bad. Yeah, we could see a down market. I don't think that's going to happen. I think that's a low probability. I think economic data is going to continue on the same trend it has been, and we're going to continue to see earnings grow and stock prices reflect that. And that's why I strongly believe that we'll be on the high side again. Call it 7,700 to 7,900 on the S&P, and we're at 6,800 today. So that puts that in that kind of 12 to 15% return 12 months in the future. So, well, thank you all for joining us for today's webinar. Hopefully everyone is ready for the holiday season. I am. I would say I did my shopping for the people that I'm responsible for. That has all been done. Some years I'm better at than others, and this year I got that all taken care of. So looking forward to spending time with family. Hopefully you all are as well. Check us out, our website, keenwealthadvisors.com. You can see the previous replays of the webinar that I mentioned on here that I, hopefully, if you do have some time, we'll probably talk about it on a podcast. So check out our future podcasts too, because I don't have a crystal ball, but when we just use data to make analysis and use, just take the emotion out of it and just look at the things that you can have some pretty good future projections when it comes down to that. And if you need a stocking stuffer and you want to give out Mr. Keen's Amazon best-selling book, Keen on Retirement, Engineering the Second Half of Life, second edition, send me an email, mwilson@keenwealthadvisors.com. Happy to have him personalize one and get that sent off to you. Again, happy holidays, Merry Christmas, Happy Hanukkah, Happy New Year. We will see you all in 2026.